Good morning, traders and investors. It's Thursday, March 23rd. Roger Scott here, Senior Strategist for Wealth Press. Boy, oh boy, oh boy. What a day yesterday, right? Well, I was halfway right. I was correct about the bond market going up. But unfortunately, the stock market went down 500 points and took utilities down with it, while utilities was actually trying to rally in the morning hours. Let me show you what I'm talking about. Rallied right here, rallied right here, and then the market took it down. All the indices fell. It's really hard for the stock indices to stay higher when the overall stock market is dropping 500 points. But what's interesting is this. Look at volatility. Volatility went down yesterday, which is really, really interesting. And actually, looking at the top stocks, most of them are still looking really, really good. I'll go through that in a bit. So I think this is an overreaction to what we're seeing, and I am seeing a bottoming pattern in a lot of different industries like industrial. We're short PCAR right now, which is a good thing. But the point is that you just can't predict what the Fed will do with a 100% certainty. Or more importantly, we did predict what the Fed was going to do, but it's very difficult to figure out the reaction based on his comments, which is really what killed the market. As far as data today, let me just show you what's going on so we can move on to the nitty gritty. As far as data today, we've got jobless claims and we've got new home sales. The Chicago Fed national activity, current accounts, that's not really all that bad. Jobless claims, we've been right around 200,000 now for way long. And new home sales, well, all the home sales data is outperforming estimates. They were looking at 645. They're looking at between 630 and 660. But housing starts, existing home sales, building permits, all was up. So I'm expecting this number to do pretty well too. And by the way, new home sales typically improve as we head into the summer because folks want to make sure they have an address before they register their kids to a new school. So we may be seeing new home sales. Existing home sales, although they're better than expected, they're still down over 20% year over year. Now, this morning, as I will show you right now, indices are up pretty good. The Dow's up 77 points. The Nasdaq is up 120 points. It'll be a very, very interesting day, and I don't want to make too many trading decisions till we get into the trading session. I am seeing some pullbacks on stocks like GE, PanW, really high quality stocks at this time. I may want to take advantage of them for some of the programs. Now, let's talk a little bit about what happened yesterday and how we could take advantage of it and why I feel so passionately negative about Jerome Squirrely Powell. He always has to, he just can't control himself. He can't just stick to the facts. He has to predict. He has to anticipate. First deflationary, then inflationary, then we're not stopping anymore. It would be just great for him to just stick to the facts, which he has really great difficulty doing. But let's talk about what happened yesterday. U.S. benchmark indices closed sharply lower on Wednesday as Federal Reserve Chairman Jerome Powell dismissed market bets on rate cuts later this year following the central bank's widely expected 25 base point rate hike. He dismissed market bets on rate cuts later this year. You see that? That was right there. That's the problem. The Federal Reserve, after he said we're going to start deflation, February 7th, I believe. Don't get me started on this guy. The Federal Reserve raised rates by 1/4 of a basis points, now ranging at 4.75 to 5. We are probably going to go to 5.8 to 6 before we're done. That's the highest level since September of 2007. At the same time, Jerome Squirrely Powell said federal officials don't see rate cuts this year as inflation pressure continues to run high. So he just put a cap on that right there. He didn't have to do that. He could have just said, we'll see what happens. But instead, he's got to give us his opinion. Adding to the Fed is ready to raise rates higher than expected if it needs to. He couldn't just say, we'll see how economy goes. We'll see how things go over the next 6 months. He just had to lay it out there. However, the Fed kept the terminal rate forecast unchanged from the last estimate in December at 5.1, signaling only one more rate hike this year. I wouldn't hold my breath. I think we're going to see more rate hikes this year, especially if Mr. Jerome Squirrely has anything to do with it. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that's sufficiently restrictive to return inflation to a 2% over time. That's what the post-meeting statement said. So a lot of folks were hoping this was going to be it. It's not. It's not going to be it, and I told you that was going to be the case. Meanwhile, Powell said the U.S. banking system is sound, but noted the recent developments would likely tighten credit conditions. That's okay. That's kind of what I expected. He kind of glossed over it. Powell added the Fed will use all tools to ensure the banking deposits remain safe and sound. That he did a fairly good job, and that's when the market rallied, and then he had to step in it as he usually does. Today, we're looking at U.S. new home sales. As I mentioned, the numbers have been very, very stable. I'm not expecting anything major. Even if the number's off a little bit, I don't think that's what's going to drive the market. I think the biggest factor is Powell with his shenanigans. Europe, futures are down just a hair this morning as market participants digest the latest interest rate hike by U.S. Federal Reserve and comments from Mr. Jerome Squirrely ahead of the Bank of England's interest rate decisions. China closed higher as major technology stocks gained ground, boosted by an over 8% jump in Tencent holdings after the company reported better than expected fourth quarter revenue. That's an interesting tech consumer discretionary. That's a music download service from what I understand. Japan closed lower as concerns about global banking sector continued to weigh on sentiment, and the yen strengthened following the Fed's monetary decision. KB Homes rose more than 2% pre-market. I like that. Chewy fell over 6% pre-market. Let's see how General Mills did. I think General Mills was supposed to come out with numbers. Yeah, they look pretty good. All right. Well, I guess we should have held on to it. Well, not really. We did fine with it. But we got out of this yesterday before the earnings announcement because the implied volatility on the options was moving. And it was probably a good decision that we did that. Now, looking at a couple of stocks, let's see if PanW, it's not really giving us an indication where it's going to open. But it'll be very interesting to see how stocks trade the first part of the day. Now, looking at sectors, you could see here, we had indexes just fall apart yesterday. And I think today we're going to get some reprieve and we're going to get some upside move. Now, as far as sectors are concerned, technology communication services is still leading. But in my opinion, in my humble opinion, the best sector right now is consumer staples. First of all, consumer staples is very defensive. Second of all, we're having a nice little upside trend here develop, which I like. And third of all, if you look at momentum levels, consumer staples, it's actually moving higher. It looks like it bounced up and it's moving higher, not lower. Let me show you. See that? While the rest of them look like they're just bottoming out or heading down, as you will see right here by the consumer discretionary. Let me show you this. See how it's heading lower? That's consumer discretionary. Look at technology. Notice it's still headed lower. Look at infotech. It's headed lower. But if you look at a few others, like for example, look at utilities. It's done. It's turning right now. I mean, really, really turning right now. Look at basic materials. It's at the bottom right now. Look at energy. Looks like it's bottoming out. So to me, it looks like all the bluer chip stocks are about to start moving higher, but there's more weight and pressure on tech stocks. And that makes sense, especially with Mr. Squirrely. I think I'll just call him that. Mr. Squirrely talking about more potential rate hikes, which are not good for technology. It could be that the technology sector is already pricing it in and not behaving too much as a result of it because the worst is probably behind us. And if you look at the small caps, which I always do in these type of times, they've been going sideways. They haven't really reacted very much. So to me, it looks like the market is just stabilizing and waiting to move back up because I believe the worst is really behind us. I don't think there's just that much downside pressure. Now, I'm looking at a bunch of stocks right now to the upside. Let me show you a few that are on my look, so you could see exactly where I stand right now. Oops, wrong. Here we go. 24-week highs. You've got Nvidia right now looking really good. You've got the stock Perry looking really good. You've got this Squarespace looking pretty good. There's a couple of stocks looking good. One of the stocks that I'm looking at is GE right now. It pulled back down and it looks like it wants to come back up again. So that's one of the stocks I'll be looking at. Instead of, if you're looking for ETFs, one of the best bets right now would be buying a call in the consumer staples. I think consumer staples, they got upgraded last week, and I think they're looking better than expected. Consumer staples, let me get you a call for that. Yeah, I think we're about to move higher, not lower. And if you look at options, I think 58 days is good enough. Implied volatility is not all that high either. I would probably go to the 73, 74 strike price. You've got plenty of time left. The options will get, as the market opens, the options will get nice and tight. But you definitely want to start checking these out, especially after the market settled down like it did yesterday. Now, in terms of market moves, let me give you some levels here. So I think the market's going to back up today after this and continue this upward trajectory. I don't think we're going to see more downside. I think the worst is behind us in terms of this Fed announcement. So I think we're going to stay above the 200-day moving average. If we break, I'm going to tell you right now, if we break yesterday's low, 391, there's a good chance we'll go lower, but I don't think that's going to be happening in the near term. I think momentum levels are going to stay firm, and I think we're going to see upside in the broad market, not downside, as a result of today's action. So let's be very cautiously optimistic. Looking at the Dow Jones, I think we're also going to rally or just kind of stay choppy, but we're right at the 200-day moving average, and I think we're going to just remain near this level. I'm not seeing a huge trend developing right now. The 200-day moving average is at 32,300. I think we're going to stay there. And looking at the QQQ, which is above the 200-day moving average, I think we're going to stay above the 50 and the 200-day moving average, and the market is looking stronger right now with the breakout. So I'm not seeing too much downside. I mean, Nasdaq's almost recovering what we've lost. I'm seeing a jump in pre-market data. So I think we're going to see upside today in the market. So be careful with your short positions. We didn't cover two shorts yesterday in VIP. I may do that today before or right at the time market opens. Keep an eye on the signal for that. But I think the market is going to be headed higher for the next few sessions. Again, XLP ETF, 73, 72 strike price. Don't get too emotional about the current market. We got to get out of this rotation, this gyration, and we got to start seeing some upside. But I think right now, over the near term, I think we're going to see some lower volatility and lower directional range, and the market's going to start getting into a trend for the foreseeable future, because there's no real huge data except for durable goods tomorrow and James Bullard speaking, and there's nobody as bearish as Squirrely. So I think he's going to reinforce that the market is okay and we may need additional rate hikes, but I don't think anything crazy is going to happen. We're also going to have the PMI composite flash, but durable goods is the big orders. We don't have employment data tomorrow. So I think the market's going to rebound and give us some upside in the next couple of sessions. I think yesterday was an overreaction. I think we got to take it as a win that the Fed rate went 0.25. And again, it was his forward-looking statements that put us in this position that we're in right now. Now, folks, before I let you go, before I let you run wild, billions of dollars, and I mean billions of dollars are flooding in and out of stocks every day. I mean, just look at yesterday. It was billions of dollars flooding out of stocks yesterday, but it works both ways. And when just a fraction of that money hits a single stock, that injection of capital has the potential to set it exploding higher over the next 24 hours. Yes, it's one of Wall Street's best kept secrets. That's why my good friend Chuck Hughes and I held a special event to pull back the curtain and reveal how the rest of us can target these stocks. It's very cool. It's simple, it's effective, no combination, no spreads, no expensive options, no monkey business. No monkey business. Follow the link below. You cannot miss this presentation. Do it now, take advantage of it, and I'll talk to you guys later. If you have any questions, send me an email at support@marketgeeks.com, or go to the YouTube Wealth Press channel, put your comments, I'll respond there, and there's a Telegram channel link there as well. I hope you guys have a great Friday Eve. That's right, Friday Eve, and I'll talk to you guys later. Bye.